Today I want to talk about how to decide whether working with a financial advisor makes sense for you, and just as importantly, when it might not. My name is Alan McDonald. I'm the founder of A&E Financial Services, and I provide an educational approach on how you can live your retirement to your truest potential. Before we get started, I want to be transparent. I'm a financial advisor. What I'm sharing with you isn't just theory from a textbook. It's based on what I've seen firsthand inside this industry from working with real people who are trying to make smart decisions when it comes to their money. At the end of the day, the question of whether to work with a financial advisor comes down to one thing. It's called value. And when you hire an advisor, yes, there's going to be a cost. The real question you need to ask yourself is whether the value that you're receiving is greater than the fee that you are paying. Most people start by asking, how much does an advisor cost? And that is a fair question. You should absolutely understand how much that you're paying. But if that's the only question that you're asking, you're missing out on a bigger picture. A more important question is, what does it cost for you to not work with a financial advisor? What would be the cost of not having the correct investment mix throughout your retirement? What's the cost of missing out on tax strategies that could save you tens or even hundreds of thousands of dollars over time? What's the cost of making a poor financial decision at the wrong moment? And what's the cost of not maximizing your retirement income? And I think one of the most overlooked costs of all, what's the cost to you when it comes to peace of mind? Sleepless nights, constant stresses when it comes to money, second guessing every decision that you're making, and always wondering if you're doing the right thing financially. Those things have a real cost, even if they don't show up on a statement. So today, let's walk through what a good financial advisor should actually help you with so you can decide if the value outweighs the cost. First, let's talk about investment allocation. I can't tell you how many people that I've met who have a portfolio that's like a 60-40 or a 50-50, maybe even a 90-10. And when I ask how or why, the answer is usually something like, that's just what I've always done. Someone told me years ago that this was a good mix, or I read it online. And that kind of information can be costly. Being too aggressive does have a cost. A major market downturn at the wrong time can seriously impact your ability to sustain your lifestyle. Also, being too conservative will have a cost, and that cost is lost opportunity. Over time, the difference between the right allocation and the wrong one can easily amount to hundreds of thousands or even millions of dollars. Now, some people say, Al, you can't beat the S&P 500, so why even bother hiring an advisor? That's missing the point. Financial planning is more about just beating an index. It's about building a portfolio that fits your goals, your time frame, and your comfort level, using diversification across different types of investments and not just one index. Having the right allocation for you is far more important than trying to outperform a benchmark, especially when it comes to sustaining a comfortable retirement. A second major benefit of working with a good advisor is tax planning. If you ask an advisor a tax-related question and they immediately tell you to go ask your accountant, that's a red flag. Taxes and financial planning are deeply connected, and you can't separate them. Most retirees have money spread across different account types: RSPs, TFSAs, non-registered accounts, permanent life insurance, pensions, OAS, CPP, and each one is taxed differently. The order in which you withdraw from these accounts matters, and getting it wrong can cost you significant amounts of money. The goal isn't to just grow your portfolio. The real goal is to maximize how much you get to keep after taxes, what's in your pocket, not just in the first few years of retirement, but in 10, 20, or even 30 years down the road. Another key benefit to retirement income is planning. Many people rely solely on the 4% withdrawal rule. Take 4% from your portfolio in retirement and adjust for inflation. Now, this is a useful guideline, but blindly following it can leave a lot of money on the table. The 4% rule was designed around worst case scenarios, retiring in poor markets with high inflation. But if you don't retire into the worst possible environment, taking only 4% will mean that you are unnecessarily limiting your lifestyle. That lost income has a real cost. It's fewer experiences, fewer trips, less time with your family, and missed opportunities during the years when you're at your healthiest. and the most active, and you can't get those years back. And finally, a good advisor provides behavioral and emotional boundaries. Think of it like the sport of golf. The more swing thoughts you have, it will not help you play the sport any better. While simplifying the golf swing with minimal thoughts will help you play better and have more fun. Anytime that I shot a course record or won a provincial championship, I wasn't thinking about a swing thought or the final outcome. In retirement, it's easy to overspend early, or on the other extreme, to underspend out of fear. Overspending can jeopardize your financial security, and underspending can cause you to miss out on life, only to realize years later down the road that you could have comfortably afforded the most enjoyable parts of life. A good advisor helps you keep in the middle of the fairway, giving you the confidence to spend when you should and be disciplined when you need to pull it back. That's exactly what a good financial advisor should do for you in retirement. When you retire, there are two very real risks. One is spending too much too early, and it's easy to say, I'm retired now, I'm gonna travel, I'm gonna spend, I'm gonna enjoy my life. And absolutely you should. But without boundaries, spending can become unsustainable, and over time, you can drain your portfolio to the point where it can no longer support your income needs later in life. I'll give you an example. Retirement spending doesn't move just in a straight line. Instead, it often follows a smiley face pattern, reflecting how life and priorities will naturally change over time. The go-go years are filled with excitement and freedom. You finally have time to travel, say yes to experiences, enjoy hobbies, and create memories with friends and family. Life feels full, active, and rewarding, and spending is much higher because you're truly living the retirement that you worked so hard to achieve. The slow-go years bring a gentle pace. Traveling becomes less frequent, routines feel more comfortable, and days are getting quieter. Expenses tend to ease as life becomes simpler, more familiar, and more focused on comfort rather than adventure. And this phase often feels more calm and more settled. The no-go years are about care and security. While activity may slow significantly, costs can rise again as health needs will change and support becomes more important. Spending shifts from experiences to ensuring dignity, comfort, and proper care, not just because you want more, but because peace of mind matters more. This smiley face pattern reminds us that retirement planning isn't just about numbers, it's about preparing for every stage of life, emotionally and financially. The other risk is the opposite, being so worried about the future that you spend so little. This is where opportunity costs quietly creep in. You're so focused on not making a mistake that life does pass you by. And then in 10 or 15 years down the road, you realize you have way too much money than you ever thought about spending on. But you can't get those years back. You can't redo missed trips, lost time with family or hobbies and experiences that you've been putting off. A good advisor acts as those personal boundaries. They help you stay in your lane, giving you confidence to spend when it makes sense and discipline to pull it back when needed. So you reach your final destination without slicing one out of bounds. Now, my favorite benefit of working with a good advisor is this: it does lead to happiness. There was a study conducted by a researcher named Sonia Luder, and she just looked at, I would say, hundreds of thousands of people, some who worked with a financial advisor and some who didn't. And what's interesting is she wasn't focused on investment returns or tax strategies or government supplementation programs. She wanted to understand one thing: happiness. And what she found was fascinating. Around 1.2 million in investable assets was the point where people began reporting significantly higher happiness levels when working with a financial advisor compared to those who didn't. Below that level, there often isn't enough complexity for an advisor to add substantial value. Once household assets reached about $6 million or more, the level of happiness between the customer and with the advisor was higher than it was without a financial advisor. Once household assets reached 6 million or more, the level of happiness between customers with and without advisors was higher than any other level. But once assets grow and decisions become more complicated, the benefit does become quite clear. That happiness advantage continued to increase and eventually leveled off around 6 million in assets. Importantly, this had nothing to do with simply being wealthy. It was about comparing people with similar asset levels, those with advisors versus those without. The people who worked with an advisor consistently reported greater peace of mind and satisfaction. And what does that tell us? It tells us that this decision is far more than the cost. As wealth grows, life tends to get more complex, not simpler. The responsibility increases and the margin for error will shrink. The cost of making a mistake becomes much higher, and even if someone never pays an advisor a dollar, but spends retirement filled with worry and anxiety and second guessing every decision, that is a heavy burden to carry. There's a saying I like: if you're still worried, you aren't wealthy. True wealth isn't just having money, it's having peace of mind to know that your money will do what you need it to do. That's why I often say that the goal isn't just money itself. The goal is what money allows you to do. It's about time spent with family, meaningful experiences, freedom to travel, the ability to support causes that you care about, and maintaining a lifestyle that brings you joy and fulfillment. Money is a tool, and if it's not being used to help you get the most out of life, then you're missing the entire point. A good financial planner shouldn't just talk about investments and taxes. They should be helping you align your financial decisions with the life that you want to live. To wrap things up, here are a few signs that it may be time to interview a new advisor, or possibly change one if you haven't already. First, if all your money is concentrated in the S&P 500, you may be chasing just performance. The S&P has done incredibly well over the last decade, but history reminds us there are long periods where it doesn't. Retirement planning requires more than hoping recent trends continue. Second, if money keeps you up at night or is dominating your thoughts throughout the day, that lack of peace of mind is a signal. No matter how much you have, constant worry means something is missing. Third, if you don't know what you're on track for, when you can retire, how much you can spend, or whether you're actually okay, a good advisor can help bring clarity by looking at the entire financial picture and not just your investments. Fourth, if your statements are filled with dozens of overlapping funds, like an example, a bunch of mutual funds, you might be owning the same holdings multiple times. Complexity may be masking confusion, and good planning should simplify and not overwhelm. And finally, if tax planning isn't an integrated part of your financial strategy, not just something deferred to your CPA, that's a major gap. Taxes do touch on every major financial decision that you will make in retirement. And if your advisor is recommending that you go to an accountant regarding every tax situation, you may want to interview a new financial advisor. Now, in many areas of life, we will willingly pay for expertise when we want things done properly and efficiently. If my car breaks down, I could try and fix it myself. But if I want it repaired correctly and avoid having to redo the whole work, I'm better served hiring a qualified mechanic. The same applies to something like baking sourdough bread. I could gather all the ingredients and attempt it on my own, but a baker who has spent years perfecting the craft is probably far more likely to be successful than I ever will. At the end of the day, the purpose of financial planning is simple: to help you live your life with confidence, clarity, and peace of mind, and to help you get the most out of life with your money.